All right, folks, thanks for waiting. Welcome to today's Sovryn Tea. Thank you for joining us today. We're going to talk about lessons learned from the Celsius fallout, amongst other things. My name is Magnus, and today we're joined by Edan Yago and Scott Melker. Scott Melker, you probably know he's a crypto trader investor who's host of the Wolf of Wall Street's podcast. You can also find him on the Wolf Den newsletter and his YouTube channel. And guys, if you enjoy sipping Sovryn Tea, you'll know I like to start things off with a joke as an icebreaker. So here we go. Knock, knock. Who's there? Satoshi Nakamoto. Satoshi Nakamoto who? You will never know. Yeah, thank you, folks. Thank you. Thank you very much. All right, let's get going to the Sovryn Tea. All right, so we have a range of questions from the audience who've submitted them via Discord and anonymously. So we'll get going here. This is for both Scott and Yago. It's from One Digit from Discord. So he says, I know we encourage people to hold their own keys and do your own research, but many people aren't technically inclined enough to participate in DeFi opportunities. In fact, they may just be likely to lose their funds that way than by entrusting them to a centralized entity. What would you say about that in the present state of the ecosystem, and what can be done going forward to reduce the risks for people who aren't technically inclined?
Seemed like Yago was ready to go, so I'll wait for him.
Okay.
Yeah, I was just saying hi to you and to everyone else. And Magnus, I was going to suggest maybe before we jump straight into the questions, talk about what the fuck is going on.
Fair enough.
Sounds good.
I mean, so and Scott, I'd be interested to hear your thoughts, and I have some of my own. This cycle surprised me. Mostly, it surprised me. I mean, there were some things which played out exactly the way I thought, but I think the big thing that surprised me was how relatively anemic this cycle was. Right, so we struggled to get to, what it was like under $70,000 per Bitcoin in extremely positive sort of macro environment with inflation and adoption by companies and countries. And then we fell off that hill, rolled back down, and kind of managed to slightly crawl our way back up before coming all the way back down, closer to the tippy tops and of where we were in the last cycle, and maybe below that, making it a pretty unimpressive upswing relative to the others. And I'm curious to your thoughts as to sort of how what things played out the way you thought they would, what didn't, and why.
It's a great question, and there's so much to unpack there, I think. I think it's important to note, sort of, as you touched on, and I hope you guys can hear me. I'm having a little bit of phone trouble. But important note that you touched on, people, I think, don't realize that we've effectively had 13 to 14 bad months with one good month sandwiched in between, which was October last year, right? So you can almost effectively view the 65,000 highs of 14 months ago as the top, and then sort of a fake out, afterwards in October where we got up to 69,000, which almost feels at this point like it was a massive exit pump, unfortunately, right? But ever since the Elon Musk FUD, China FUD, that entire part of the cycle, which, as you touched on, was still in a positive macro environment, this market has effectively struggled, right? So I share the surprise with all the things that you said. I was absolutely a moon boy with 6K targets, which, by the way, at 70,000 and 100,000 on a logarithmic percentage-wise basis is not really that far off. But I think that we've been massively humbled by quite a few things. And obviously, the topic here is lessons learned from Celsius. And I would argue that our problem should be lessons learned from, 2008 or 2000 or the 1970s. I mean, choose any macro global legacy recession or depression. And we just went ahead in the crypto industry, and I will not say the Bitcoin space, but in the crypto industry, and replicated everything that existed that we hate, but with actually less protection for consumers and less education for the people who are using them, right? So we basically built a bunch of things that were almost guaranteed to break. Now they're all breaking in rapid succession because we're finally not in a positive macro environment. And by the way, positive macro environment is still a shit show because that was defined by money printing, which we know, false bullish environment that was completely fabricated by the Fed and by money printing. But for me, I was talking about this. I had a live stream. I do a panel every Thursday morning. Yago, you should absolutely come on very, very soon, anytime. We're long overdue. But I had Jimmy Song on there. Obviously, we all know his opinion. Robert Breedlove, we all know his opinion. I had Seth Gins from Coin Fund, who's obviously VC and more technologist. It was a really riveting sort of debate, which was more screaming. But the fact is, there's sort of this horseshoe, as Breedlove pointed to. I called it a circle, but you generally, if you came in earlier than this cycle, you probably came through Bitcoin, right? And then we're all guilty of it. You start experimenting with all these other things, technology is the future, speculative, whatever, and then shit blows up, and you all come back to being Bitcoiners, right? And so I think at this point, it's very important you talk about what someone asked the question. I think kind of heard it at the beginning. I mean, at this point, the safest thing, I'm not saying I have nothing against any of these platforms, but like if you're just a uninformed retail investor who hasn't done the work or doesn't have the capacity to do so, you just buy Bitcoin and wait a while and you'll be fine, right? And I'm not saying there aren't amazing things being built, but I think it's important to remember that we are in that Bitcoin first environment. Everything else is, Fidelity had that incredible report, Bitcoin First, not long ago. So there's Bitcoin and everything else. That's not a knock on everything else, but everything else is a venture capital tech investment. And by the way, venture capital tech investments are the biggest companies in the world if you invested in those in the 90s and 2000s. So like I said, don't take that as a negative. I think there are incredible things being built, but if you're brand new here, we got to go back to the original ethos, which is start with Bitcoin, start accumulating, start dollar cost averaging, ignore the charts, just buy this asset with a low time preference, long time horizon, and chill for a while. I mean, I as horrible as it is and painful to see our portfolios, I'm fucking buying to $20,000 Bitcoin without even a thought, right? And anyone who bought it at 69,000 is scared to buy it at 20,000 doesn't understand how this works.
So I think you make really, definitely that's my philosophy in terms of a person can only concentrate on so many things, life is the stress is just the destroyer of life. And the best thing that you can do for yourself is make long-term investments and then forget about them. We also know that this strategy basically outperforms every single other strategy that exists, not just for retail, but for everyone, right? I mean, so index funds, which is a form of passive investment, outperform hedge funds in any time frame that you care to look at them. People typically end up making most of their money from their most passive investment, which is real estate, right? And I tend, one of the things that I say is our parents' generation just had to do one thing right. They could fuck up on everything if they made one right decision in their life. They bought a house. They're millionaires. Every generation is given a similar kind of scenario. Our grandparents' generation was you could fuck everything up, but if you got a college degree, you were fine. Just do that one thing. Our generation, same thing, right? You can't sell it. You can't sell. You don't sell your college degree. You can't sell. You don't sell your house. You can't sell, you don't sell your Bitcoin. You make the one decision, and that gives you latitude to fuck up everything else in your life, including kids, and they still will be fine. And I think what you said about, everything else basically being a tech stock, right? it's not just a tech stock, it's a super early tech stock. And it's a super early tech stock in an industry which is pre-maturation. And then we decided to sprinkle leverage on top of that. So, coming back to what I asked, the question that I've been asking myself is, why was this cycle more anemic than the other ones? And I never bought into the super cycle. We're going to the moon with no stops. Don't collect 200. I never bought it because nothing fundamental had changed. And about 3 years ago, I was sitting in a coffee shop with someone from Outlier Ventures in London. And I was explaining to him my view on where this market was going to go. And I said, this is going to be, significantly bigger than the 2017, 2018 cycle. And he didn't believe me. He said, there's no way. I mean, think about how big that was. I said, no, it's going to be way bigger. And the reason it's going to be bigger is because this time we're adding leverage, right? This was just the very, very beginning of DeFi, but you could already see, Compound existed, MakerDAO existed. They were very, very, very tiny, but they were there, and I was convinced that what was going to happen is that people would see this, latch onto this, and we would get leveraged up the wazoo. And so my expectation was that this would be way, way bigger. But what's happened is the drop has been very, very significant, basically the same as every other time. The top was less, and I think that leverage is one half of the answer as to why that is. Because when what's driving you up is leverage, then you're not being driven up by dollars that are being pumped into the system. You're being driven up by dollars that are being recycled in the system. And so you're being driven up by air. There's this massive air gap, right? Anytime that there's a small drop, it gets magnified because of margin calls, and it also means that there's constant downwards pressure through funding rates, so that basically the tops all get arbed out, but nothing really stops the liquidation cascades to the bottom. And so maybe a more fundamental question is, why was it obvious that we would go through another cycle? And it's because these cycles are driven by greed and then fear. That's it. It's not more complicated than that. It's the only market that everyone in the world can enter. And as a result, the way I made peace with what was happening in the ICO boom was I said, oh, well, we built out a use case for decentralized, permissionless stuff. And that use case is the most obvious use case. It's the world's biggest, world's best, world's most accessible, and world's 24/7 casino. And when you walk into the casino, the only two things you smell are fear and greed, and they hit your nostrils through the sweat. So we've created an amazing casino where we take a pre-product market fit industry, not just products, but pre-product market fit industry, and lever it up. Now, I don't know if that really does explain, that's part of the explanation, or I think why it was more anemic on the upside. I think the other part of the explanation for me, and I'm curious on your thoughts, is that this casino, I think, has saturated the market for gamblers. The market for gamblers is pretty small, right? I mean, most of the world, most of finance, most of the money is not in gambling. Like, gambling is a tiny fraction. Most of the money is in long-term in savings, really, like vehicles which are designed to preserve wealth, not increase it. Like, if you can increase it, great, but mostly it's to preserve it. People hold cash in their bank accounts. People, have real estate. People put money into bonds and stocks and sort of dividend stocks, and it's not just like regular people. Like the wealthiest people, the wealthier people get, And the bigger institutions get, the more conservative they become with money. And so I think what we may have done in this cycle is we've reached the saturation point of gamblers, but we still haven't flipped the switch to where you are, which is if you want to make the best, if you want to preserve your wealth, you just basically buy Bitcoin. And this might see, from this point on, we might see Bitcoin, and it won't happen today or tomorrow, but over the next, couple of years and into the next sort of upswing of the cycle, which is inevitable, we may see a bifurcation now between Bitcoin and everything else, because the gambling market is saturated, but the savings market we've hardly even tapped.
I think that's an optimistic view, and one that I would hope to see, but you have a lot more faith in humans not repeating their mistakes, I think, than I do. But I do think that every time these cycles happen, there's a flush, and we get more people sort of spinning off in the proper direction. I mean, you talk about the crypto market being a 24/7 casino. Last time I went to a casino, at least I got free drinks and comped a room when I lost my money, right? So this casino sucks. Yeah. But the point being, the question I think about this cycle, I think leverage is a huge part of it, and we've only seen increased leverage and availability of leverage with time. And what we're seeing right now is also the problem that really points to that I think is the most significant. And I really don't have an answer to why the cycle didn't go higher. Maybe just because global markets turned on us and we were more correlated than we thought, and it was just bad timing. But counterparty risk and the lack of understanding of the counterparty risk, to me, is certainly the entire story for this downturn, right? If you're a retail investor, you trust the platform that you're parking your money with, but you're not just trusting that platform, and you don't realize that. You're trusting that platform is doing due diligence on every single person that they're lending or borrowing from themselves. And then it goes, 1, 2, 3 layers deeper than that. And that's without having a Celsius type situation where they're actually actively yield farming effectively in DeFi, right? And it's so easy in retrospect to look back and said, I should have known. But for your average person in the world, I mean, we talk about, right, Celsius, unbank yourself, right? That's their credo, their motto. If you see that, unbank yourself, and you live somewhere in the world, because let's forget about us in America, whatever. If you live somewhere in the world where you don't have any access to banking, you have a mobile phone, you don't have internet, and you see, unbank myself, holy shit, not only can I finally have a bank account, because people thought these were banks. Not only can I have a bank account, but I can have a superior bank account that I'm earning yield. That person is never going to go, holy shit, they're taking the money and they're parking it in USD, and then it's on Anchor, and they're shorting this, and they're longing that, and they're hedging, right? Nobody's thinking about that. And so to me, it's the lack of understanding or even lack of transparency of what the counterparties are doing. So you have to have this level of trust with every single place that you put your coins that's not self-custody, that person knows what they're doing, and then the person that they're vetting also knows what they're doing. And we're seeing this sort of tail of that. I mean, Three Arrows Capital had 10 billion assets under management, and they're gone, right? I mean, we don't know the full depth, obviously, of what's happening there, but Zach Prince from BlockFi just put out a thread within the last few hours, basically without naming them, saying, yes, we were the first to liquidate them, so good for us. Our clients' funds weren't affected, right? But and I think BlockFi handled it well. It's great that their client funds aren't affected, but that also means that if their risk engine had failed, or they had not identified it and it had taken a couple more days, we might see another Celsius. And I have nothing against BlockFi. I think they did a great job, like I said. But I mean, Celsius apparently got out of UST hours or days with $500 million before that collapsed. So it feels like we're playing this big game of Frogger, you're running out in front of the cars and just trying to dodge them. Eventually you lose. And so at this point, we can just pray that the contagion is over and we don't see further collapses. But I don't even think we've yet heard about the funds and people that were exposed to UST who were probably affected and haven't even come out or reported it yet. So I think it's a very ugly environment right now. Our best hope is that most of that leverage has been rinsed. Most of that counterparty risk is different, and that, we behave differently. But that's an optimistic view. I mean, look at the global market, right? It only took about 14 years to basically repeat all the mistakes of 2008. I was there. It sucked, right? So I give us another 8 or 9 years before we do it all again.
For the less optimistic view. All right, Magnus, maybe over to you with some questions, and we can, I think, take questions from the audience who are here with us as well.
Yeah, you bet. I mean, I suppose the point of this is to be constructive, right? So going back to our first question, in a nutshell, he was saying, what can be done going forward to reduce the risks for people who aren't technically inclined?
Buy Bitcoin, self-custody it, and then take a very, very long time to do your research and go further down the rabbit hole.
Anything out of there?
So I broadly agree with that. I think that's the first thing that people should be doing. And from that point on, there are... So one of the things that that I think I found impressive around the initial DeFi projects was that they were conservative, over-collateralized, and until Compound started giving away tokens to encourage deposits. They also were showing purely organic growth. And there's a transparency in DeFi systems which is extremely helpful. And there's also something else which is helpful with DeFi platforms, which is that they're difficult to use. And because they're difficult to use, the level, the type of user, maybe after the last year less so, but the type of user was typically more sophisticated and had a better sense of what it is that they were getting themselves into. I think the general direction of providing greater transparency is the direction that we should be going in. I don't think anyone should be using these wild, these basically shadow banks. And then BlockFi, mentioned by Scott, they liquidated 3 Arrows Capital, but that doesn't mean, So that doesn't mean that they are a responsible actor, right? They probably lost significant funds and encumbered a huge amount of user funds by playing the arbor game with GBTC. We know this, right? But what's worse is they are, you're basically giving your money to a company which already is having regulatory issues, which is centralized, and as a result, all funds could be frozen, through no fault of their own by a regulator. You have no idea how they're trying to generate the yield, and what we know that they're doing, like everyone in this market, is providing unsecured, providing loans on an unsecured basis to, supposedly big, responsible players who are not so big and not so responsible because they come from this market and are playing in this market. And like Scott says, it's a total black box. So going from banks, it's, the question I ask myself is, what is the point, right? What is the point of Bitcoin at all? If what we're going to do is make a big noise about taking back control from central banks and from Jamie Dimon, and and then we'll and putting it into Bitcoin, and then we go and just give it to a new set of centralized actors who are less regulated, have more problems, are less mature, and in many ways, far less transparent even. So I do think that what we should be doing is building out those systems which provide user transparency by default because they're on-chain. And at the same time, building out systems which can provide cohesive mitigation for contagion and for systemic loss, right? And systemic risks. The entire Ethereum ecosystem, DeFi ecosystem, has massive systemic loss opportunity, right? So USDC and Tether basically represent the entire collateral base for that entire ecosystem. Both of them are centralized players. One of them is a centralized player which is constantly at odds with the regulator. The other one is a centralized player which is a US-based company. Both of them exist in an industry, which the stablecoin industry, which we know the regulator is viewing very, very closely. The smallest hiccup from a regulatory perspective could encumber that entire base of funds. And as responsible as Aave and MakerDAO and Compound think they are, the fact that their entire asset base rests on those two assets. And in fact, and through DAI, which, DAI is basically 52% USDC, on DAI as well, right? The whole thing could disappear overnight. And so it's those kind of systemic risks that we need to be eliminating as well. And that means decentralized Bitcoin-backed stablecoins, because we need to have stablecoins. We're not getting stablecoins for the next decade, at least, right? And they're extremely useful and provide a way for people to get the value of their Bitcoin, because hodling is really hard as well, right? I mean, even in your house, you can, you can use it while you're basically saving in it, right? You can live in it. You can potentially remortgage it. You can rent it out, right? You can't do any of those things with Bitcoin, and we need avenues to do things like that with Bitcoin in transparent, low-risk ways. And I don't think that without Bitcoin-backed stablecoins, that's going to be an available avenue. And so I think if we can build an ecosystem which is basically Bitcoin native from the ground up, secured by Bitcoin, transparent like Bitcoin, and also rests on the collateral base of Bitcoin, we start building from there. We're not going to see the kind of, face-ripping growth that we've seen in other ecosystems. But that's a good thing. And I think it's also why we need to look at everything that's happened in DeFi and everything that's happened in financial history more generally as a lesson, and build those systems which are going to buffer and mitigate against those problems. I think we are doing that. And I would encourage people to look at what's going on in the Bitcoin ecosystem, a much more conservative ecosystem, a move slow and build solid shit ecosystem. And as a result, I think a far more sustainable and reliable ecosystem.
Good stuff.
Sorry.
Yeah,
go ahead.
Oh, did you want to? Okay.
I just wanted to add, I spoke with Palo Arduino from Tether, like right after the Luna collapse, and he made effectively the same point that you made there at the Edan Yago, which is that algorithmic stablecoin, not necessarily a bad idea, but an algorithmic stablecoin that's worth 50, 60, 70 billion dollars in this market is a horrible idea. He was right. If they had started at 100 million and grown over a year to 200 to 300, it was all about too big and too fast that made it so easy to collapse. So, the idea that they could have started slowly and moved more responsibly, it would definitely not have broken down.
Hey guys, how you doing? Do you guys hear me?
Yeah, go ahead, Cordy.
Oh yes, I actually asked Jack Dorsey that on June 3rd. It was a square space. It was the end of the space. I asked him, what do you think about stablecoins and Bitcoin? But the day after that, he released Web 5. Like he announced the release of Web 5, because I definitely agree with Edan, because that's one of the basic ways to get people involved, because once you add that element, everyone's able to spend money every single day. Because one of the most interesting things happening right now on RSK is this thing called RF aggregation, and I'm looking into it right now. it's very interesting where, and now I'm seeing things like ZK rollups added to RSK on Bitcoin, and things like, wow, I could add such things like other ERC20 tokens aside from the RSK Bitcoin fees. So things like that, where we could have our own stable coins on Bitcoin, but use those exact stable coins as the main source of the fees without having to go back and forth between the main native currency.
Yeah, 100%. I think that the primary use case of Bitcoin-backed stablecoins, and what is likely to start driving true economic growth, right? So right now, Bitcoin is a store of value. Everything else is a casino. And Bitcoin is a store of value only for people with a long time horizon. What we need in the middle, right, is the biggest piece, which is true economic activity. People using things for their daily activities, which could just be buying, but also means saving for shorter term periods, means being able to invest in businesses, means, being able to buy houses. That economy requires people to have access to the value that is held in Bitcoin without having to sell it. And so what effectively a Bitcoin-backed stablecoin is it's through one method or another, and there's a number of Bitcoin-backed stablecoins now. But they all basically have the same kind of principle, which is that you can, in one way or another, borrow some of the value that you've managed to accrue in your Bitcoin and use it now, and then you can either pay it off later, like a regular loan, or you can allow the long-term accrual of value in your Bitcoin to basically pay down your debt for you. Sovryn, the project that is hosting this space and that I've been involved in now, has a waiting list for a system called Zero, which creates Bitcoin-backed stablecoins and provides 0% interest. So you can take out a loan with 0% interest by providing enough collateral to make sure that dollar value is always going to be there in the form of Bitcoin. And that gives people confidence to use it. And so going back to what you said, Scott, about an algorithmic stablecoin, I don't think that algorithmic stablecoins can work under any circumstances. And my proof point for this is that we already have this massive multi-trillion-dollar algorithmic stablecoin called the dollar. And its algorithm is a bunch of guys in a room who meet, every 2 months. But that's an algorithm. Algorithm means a procedure. That's an algorithm. And the only reason it manages to maintain its value at all is because it's backed by a massive military and a massive monopoly over the world's most productive economy in the world. Without that, the dollar's worth nothing. It's paper. An algorithmic stablecoin is less than paper. There isn't even the paper. So algorithmic stablecoins can grow slow or can grow fast, but they're basically just fiat, and so inherently unstable.
I agree with that. Yeah, I was just telling the point that it wouldn't have been such a massive and quick collapse in a different scenario.
Yeah, I'd agree with that as well.
Okay, so let's move on to another audience question here, and this is more or less for Yago. How is Sovryn protected from a bank run like Celsius?
Yes, so a bank run can only occur in scenarios where you're under collateralized, right? So Tether is basically protected against the bank run as well, in theory, right? We don't know exactly what's happening with Tether, but so far it's managed to escape any bank run, and that's because for every dollar that is tokenized, they have a dollar's worth of value that they can provide upon redemption, right? And so the reason bank runs started, right, and this is like long before crypto existed, right? With the bank runs started with the creation of banks, and specifically banks that were lending out or creating more money than they were able to redeem in full for what was either silver or gold on demand. Basically, there's a simple rule to any type of economic peg. Without redemption, the peg will fail. We've seen this happen every single time with 100% success rate over the last 500 years. But if you have redemption, have the ability for on-demand redemption, that the peg is fixed. It could fluctuate a little bit up, a little bit down within the window of redemptions, but no more. And so when people talk about fractional reserve banking, right, which I think is a misleading term, because the reserves are there, they're just not liquid. But let's call it fractionally liquid banks. They cannot perform redemption, and then what happens is the first people to redeem get their money, the second people, last people to redeem get no money, and because the company goes bankrupt in the meantime, they don't get their money at all. And so there's this rush to the exit, right? Everyone rushes to try and get their money out as quickly as possible. Systems which have redemption, and this includes systems like Liquidity or MakerDAO or Bitcoin, a dollar on chain, which has been around for years now and has had no issue with its peg. They haven't had an issue with the peg because they're over-collateralized. They're not just collateralized, they're over-collateralized and provide a mechanism for on-demand redemption.
All right, I have a question here from Discord for Scott. It's coming across more of a statement, but the person's saying, I think one of the problems is that every cycle we're burning adopters who may never come back. Personally, I know many who have invested in 2017 that did not return in 2021. And also this cycle, I'm expecting many who got burned to not return. Any thoughts on that?
I think that that's true, but there's always more people, right? We have an entire world of potential customers, and I think, or adopters, not customers, I would say. And I think that we've only scratched the surface, even in recognition that this exists of such a small percentage that that's not hugely problematic. But it is sad, unfortunately, to see those things happen. I mean, there's plenty of people who probably never even bought Bitcoin, who literally just went on a platform like Celsius, thinking it was a bank, as I said, buying, some USDC and parking it, and now obviously will never take the next step. It's sad, but I think it's the nature of cycles, and that every cycle should effectively just increase adoption, more people, more interest, and I think that that's happening. I mean, think about 2017. Many of those people, anecdotally didn't come back, but think about the institutions that are here that would have never touched it. The fact that we're talking about sovereign states, talking about nation states adopting it, talking about every institution in the world, every big bank, where Bitcoin and Ethereum are on the ticker on CNBC and Fox Business all day. It's apples and oranges comparison of mainstream adoption versus that last cycle. So even though people that were flushed out, which will happen anytime there's basically gambling, as Yago sort of alluded to, you're going to have that, but I still think that is a monster net positive of adoption and recognition each cycle.
Yeah, I mostly agree with that. There are people who won't come back, but in a way, more people will come back, I think, than you would expect, and for the wrong reasons.
Yeah, when Bitcoin hits $100,000, they'll come back.
Exactly. A lot of the people who came in with a get-rich-quick scheme. Now, they won't come back in that way because they will grow out of their get-rich-quick phase. Get-rich-quick is mostly a young man's game, right? It's men who are under the age of 35, which is part of the reason that we're such a male-dominated industry, right? Who are extremely not risk averse, and then you have people who stick with gambling into later age. Those people are committed, right? The level of commitment that they have to gambling, I could only wish upon people when it came to savings, right? But people will grow out of that phase, and they will mature into whatever the next phase. And if we as an industry can provide true, solid financial tools, right? Sound financial tools built on sound money, and provide a window to true economic activity, they're going to be back. And there's a whole crop of new young men who are going to come, looking to get rich quick in the next phase, which likely will, it may take a little bit longer this time, but I don't think it's more than 2.5 years out at max. And the reason is we're already almost a year into a bear market. So even if this is an extended bear market, I'm not currently anticipating it will be much longer than that. Memories are very, very short with this kind of thing. Even the bear market of the total and nuclear collapse of tech stocks wasn't more than 2 years. So by 2003 things were growing again. After 2008, by 2011 things were growing again. And with crypto, we've seen the cycle. Basically it's 2 years on, 2 years off. So I think the future is likely to continue to rhyme in that way.
Hear, hear. Guys, just so you know, you can submit to be or request to be a speaker if you want to ask a question to our guests here. Hey, I have another anonymous question here. It says, what happens if Bitcoin falls under 20K?
Then it's cheaper than 20K. I don't know. It's $400 cheaper than it was when it was 20,399. I don't think it's a relevant number. It's just a line on a chart, and we all know, even the technical analyst and myself, and I love it. I joke that it's astrology for men. 20,000 is just another number. I would say though, like if we're talking about leverage, that it drops significantly below that would probably be, as what I alluded to before, if there is still a ton of leverage in the system. I'm not talking about retail leverage. I'm talking about institutions like 3AC and Celsius that are leveraged and could be margin called. MicroStrategy is not one of them, no matter how much FUD you hear. I think that there could be one more massive drop if that triggered a whole bunch of liquidations or stop losses, because that's a psychological level and was the top of the 2017 bull run. But we love to sort of assign importance to certain levels or certain numbers, and the reality is 19,999, that's $1 below 20,000.
All right, sorry, you cut off at the very end there, which is why I didn't hear you. I did have another question here from an anonymous person. Can you compare and contrast the SOV token compared to CEL or CEL? I don't know how you pronounce it. It's mostly for Yago there.
Yes, I'll take that one. So SOV is the token of the Sovryn ecosystem. Right, and so Sovryn ecosystem, I mentioned it before, is building or seeking to build a world on Bitcoin, a true economy on Bitcoin, and starting with sound financial tools on Bitcoin. And so there's a token which is the coordination and governance token of Sovryn. And it's very, very different from CEL and most other tokens. It's different from other ecosystem tokens because it's not trying to be its own coin, right? It's not trying to be a coin at all. So Bitcoin is the coin. But it's different from things like CEL, which are, CEL, I don't even know how to define it. It's just like it's made up and the points don't matter. Like I can't understand what the value of CEL is, right? It doesn't give you voting rights. It doesn't give you stakeholder or equity rights. It doesn't give you revenue rights. It's just sort of like it's like a meme coin. But there are more sophisticated tokens out there which I still think are fundamentally broken. So, for example, Uniswap, I think, is a very, whether or not it survives long term, I'm skeptical. I don't think AMMs make sense. Most people who use AMMs lose money as liquidity providers, the vast majority, even on the most active pools. But but it's used, and it drives revenue, and it's used in an organic way. But the Uni token has no value. It's sort of got the same name, but it has very limited voting potential actually in the Uniswap ecosystem, and provides no revenue. SOV is a much simpler idea, which is the protocol generates revenue. It pays that revenue in BTC. You stake SOV, and you get to have ownership of the protocol and earn what the protocol earns. That's a very, very old model, right? It's basically the model that was invented by the Dutch 400 years ago. It's like akin to equity. It's like equity now with greater transparency and without need for courts. And it's a model that we know works. So I think, it's true that Scott said, we've reinvented all of the bad things about finance. I think it's time that we started reinventing the good things about it as well. Finance is amazing. Finance is what makes the world go round. Finance is basically a tool for the allocation of capital towards innovation and growth, right? You invest in those things which are going to be more valuable in the future. Planting a tree is an investment, right? Investing in a company which has the ability to grow is an investment. Investing in research and innovation is an investment. The rest is speculation. So I think we've reinvented the speculative part of finance. And with SOV as an example, there's also the opportunity to reinvent and improve and provide greater access globally to the productive version of finance. And so SOV is basically just, if you think Sovryn is doing something which could be valuable today or in the future, you can hold SOV. It's that simple.
Succinct and to the point there. Yeah, guys, I know you commented it on earlier, but I'm getting a lot of questions about Three Arrows Capital. One saying, can you comment on what's going on with that?
I think that we have to be very careful about commenting on it if we don't know the exact details, but I think it's very clear that they've at least had a margin call for about $400 million. It seems that BlockFi is hinting at the fact that they also, whether that is the same margin call or not, have liquidated the funds that they had with them. I mean, it sounds like basically they're insolvent, and there'll probably be a long line of people trying to get their money back as usual.
Yes, I don't have any insider knowledge around 3AC. The only good thing that I can say about this situation, if indeed the rumors about 3AC are true, is that 3AC at least didn't take retail funds. Right?
That's right.
The big crime of Luna, the big crime of Celsius, was that they made an active effort to go out and market themselves to the least sophisticated user. Right? When Crypto.com bought a sports stadium, right, they were not trying to attract sophisticated investors. When FTX did the same thing, they're not trying to attract sophisticated investors. When Celsius created an app which promised you, I think to quote, zero risk, all profit, right, and all you need to do is just download an app, that is... I mean, that the casino operators from the mob would look down on that kind of behavior.
I agree, but I'm not sure it was as intentional. I think maybe I'm just a glass half full kind of person or an eternal optimist. I 100% agree with what you said. I'm just not sure that they were doing it intentionally. I truly believe that probably Joe Kwan had quite a bit of hubris, but he was backed by some of the biggest money in the space and probably believed it would work, right? I don't think that he was intentionally scamming anyone. I think that he just got too big for his britches. And I think perhaps Celsius's core ethos was really to help people. They certainly didn't want to blow up, and just were caught up in how quote unquote easy it was to earn those yields in DeFi, just like everyone else. Your sentiment is absolutely correct. I would at least like to hope that they didn't intentionally do it.
I find it difficult to buy that or accept that as an argument because there's a certain level of sophistication and cynicism that you need in order to go out and tell people, all the good things about your system without recognizing the risks. Do Kwon repeatedly poo-pooed, and launched his troll army against those who would criticize Terra and Luna.
Certainly enough.
Alex. Yeah, but I mean, but I look. I mean, you could say, maybe they were too retarded to understand the risks of what they were engaged in. But Do Kwon, for example, had already launched an algorithmic stablecoin that had failed. I mean, I can't. I don't think it would be right for us to say, these were well-intentioned people who were sophisticated enough to raise massive amounts of money, build sophisticated marketing machines, build partnerships with institutional hedge funds and lend them the money, but they didn't have the sophistication to recognize the potential risk in being over-levered. I just don't buy it.
Perhaps, but I can tell you that those very sophisticated hedge funds, some of which I'm unfortunately invested in, absolutely exploded and are supposed to be the smartest and most sophisticated minds that exist in this space. So they definitely retail, but I can tell you that these hedge funds are not having a good time after believing in it either. So they also, took that pill.
That may be the case, but I'm not entirely sure. I mean, look, Novogratz got a tattoo. That's a level of commitment again where, okay, fine. All right, sure. I believe Novogratz really believed, and my heart goes out. And I just don't know. But if that's the case, maybe he shouldn't be in this business. But I think a lot of the institutional investors have become very used to always having a chair when the music stops in the game of musical chairs. Probably assume that they would be able to recognize when to get out. I don't necessarily. I think it's unlikely that they, gave a high level of probability to the fact that this was going to grow forever, which it needs to do in order to be sustainable. So,
I agree with that probably, but I can tell you in the case of Arca specifically, because it's now out there. I mean, when Luna collapsed, they were some of the biggest supporters, and they actually doubled down rather than getting out early, which was unfortunate because they're down, I believe, 74% year to date as one of the biggest hedge funds in crypto. But I can only say that they believed enough that their thinking was, oh, this thing's $24. We've done the risk assessment. We've talked to the team, and let's go. To which I shook my head, sent very angry emails. But what are you going to do? But yeah, so I can only speak anecdotally, but they were obviously one of the largest supporters of Luna and doubled down on the way down rather than escaping before things went bad.
Right. Yeah, no, you're right. You're right. Yeah, it's the lesson of humility maybe needs to be learned again and again.
The market will definitely do that to you eventually, right? They say there's two kinds of people in the market: those who are humble and those who will be humbled.
All right, Anon asks, do you agree with Samson Mao's prediction that Bitcoin will be 100K by the end of 2022?
My crystal ball is broken. I have no fucking idea. It doesn't matter. Doesn't matter. Like, this is and I'm not poo-pooing people who make predictions. They ask us for them all the time. But if there's anything we've learned, it's sort of like, Yago pointed to the fact that your parents, their generation, all they had to do was buy a house, right? You bought a house, you knew it was a long-term investment, you sat on it forever. Well, imagine if you could look at the 1 hour chart of the value of your house while you believe that you had conviction in it as a long-term investment, right? It would absolutely drive you nuts. You'd do stupid things. You might sell it and try to trade your house. That's how Bitcoin should be viewed too. So whether it's $100,000 in a year, 5 years, 10 years, it should be absolutely irrelevant to you. So we have this sort of cognitive dissonance or mental conflict between I'm buying this asset for my kids and retirement, but also, oh shit, it's down today, right? And so I think that that's highly problematic. This is nothing. I love Samson. I agree that sure, Bitcoin could be $100,000, but like yet again, like what if it goes below 20? I don't know. It'll be 19,900. What if it goes to 100,000 by July 5th? Are we all assholes for predicting that it would have had? I mean, by January 5th, are we all assholes for missing it by 5 days? Right? The timing is impossible. It's very easy to see what's coming in history. Like, listen, many will say every fiat currency has collapsed. So you can say that the US dollar will eventually collapse because that was happening literally to every fiat currency. But trying to attach a date to that is a fool's errand. So trying to attach a date to when Bitcoin will hit 100,000 when it's dependent on so many factors, I think, is just pointless. And if you're making your financial decisions based on someone saying that they have conviction that the price will be a certain thing by a certain time, then you're approaching the market from the completely wrong perspective.
Well, I like that answer. I don't have any more questions. Do y'all go any other clothing thoughts there?
I mean, you know, just a moment ago we were talking about needing to learn the lesson of humility again and again and again. Yeah, and then the next question you had was about you know, a prediction, and I think the lesson, a good lesson, is that what you do shouldn't be based on specific predictions. Like the only prediction that I'm willing to make about the end of 2022 is that it will end on the 31st of December, right? I don't know anything about the prices, but I know what day it's going to end. And I know what day it's going to end because you can fundamentally understand what date it's going to end. It ends on the same date every single year, right? The ability to you know, and we experience this in all facets of our life, right? So people know enough about this kind of foolish type of prediction when, you know, if you choose to be a software developer, right? You go to school, you learn to be a software developer. You don't say, I'm going to be a Google engineer. You say, I'm going to be a software developer. And you realize that you might end up with different kinds of jobs and different kinds of salaries at different kinds of companies. You know, when you're dating that, you know, maybe your goal is to settle down and have kids, but you don't start out when you're 16 and know who you're going to marry and believe it. Because, you know, everyone knows, you know, we call it young love, we call it a crush, you know, and we think it's cute when people do that kind of thing, right? You know, I'm going to marry, I don't know, whoever is like, I don't know who the celebrity of the current moment is, but you know, if you believe that when you're 14, it's cute. If you believe that when you're 24, it's creepy. So the way I think it makes sense for everyone to manage these things is to think about what are the fundamental things that I can believe with a high degree of certainty. I've you know, I got into Bitcoin. I was lucky in terms of how early I was able to get into Bitcoin, and I haven't sold any Bitcoin over the last 10 years. Because my view of where Bitcoin can go and should go is fundamentally driven by assessment of the way the world works, and I spend every single day trying to reassess that assessment and trying to break it. And that, for me, that's what do your own research means, right? It means having humility, trying to figure out where you're wrong, and if you can't understand something, then you recognize that you don't understand it.
it's fundamentally about staying away from short-term thinking. I, I, where it's fine to make short-term decisions around where you're going to go on vacation, but it's a very poor idea to base your life on short-term decisions. An investment in your career, in the type of education that you do. People who are making short-term decisions on their day-to-day lives are the same kind of people who have addictions, who are alcoholics or gamblers. We all recognize that we need to take very long-term view on the big arc of our lives, the big arc of sometimes people are even able to look at their lives as generations. They're not just looking at their life, they're looking at the life of their children, maybe even their grandchildren. And I think the people who are able to do that most tend to have the least stress, tend to have the greatest sense of purpose, and as a result tend to have the greatest degree of contentment and ability to find joy in their lives. And so I think we can just do the same thing with how we think about our money. We'll all be much better off.
I just want to double down on my opinion that Yago is the most pleasurable and brilliant person to share these spaces with and listen to on a regular basis. There's a reason I've had him on my podcast so consistently. But I mean, I just think that absolutely you blow my mind every time, buddy. Seriously.
Well, thank you very much, Scott, and happy to come on your cast anytime.
Yeah, I'll do it soon.
Guys, we do have one more question. Can we fit one more in? Is that all right?
Fine with me.
Yeah. So it says for the panel, any comment on STETH? Sorry if I'm mispronouncing that. In particular, risk on Ethereum because Lido controls 31% of the staked ETH.
That's all you, Yago. I try not to go too deep on that.
I'll comment on that. So I think this is, I have a huge amount of respect, and I wish more Bitcoiners had respect for everything that Ethereum has built. And I don't just mean technology; I mean culture as well. There are really fantastic facets to Ethereum culture. It's become a little bit less so, but it has been highly inclusive. It's been super future oriented. It's been driven by a desire for innovation and a willingness to build. And I think these are all extremely attractive things. But the problem that I have with Ethereum, it comes back down to those long-term fundamentals. And Lido is at the very, very heart of, I think, one of the worst things about the Ethereum ecosystem. Yeah, and proof of stake more generally. It's a system which is designed to create a huge amount of power that goes along with wealth. And because of the economics, right? I mean, you can do the fundamental economics. Because of the way that proof of stake pays out, and when you add on to that minor extractable value, so MEV, there are huge advantages to being a bigger staker. And so the long run of this is that we end up with this consolidating around a small number, maybe even just one staker. And that's possibly going to be something like Lido. And that means that the relatively small number of participants who are going to be involved in active governance are going to completely control that system. Now, we already have a system like that, right? Everyone knows it from whichever government runs the company, the country that they are their citizens in. But I'll use the US as an example because it's not mine, but everyone's aware of it, right? If you look at the way the US works, and I just see that Perianne has joined us, and she works in DC and has been an advocate for Bitcoin in DC for years, and so maybe she will want to jump on and give her own personal experience. But what you see is you've got 350 million citizens, right? About 180 million of them have the right to vote once every, let's call it 4 years. they have no idea what's going on. They have jobs, they have children, they have TV, they have problems. They've got all of their mental focus is elsewhere. And then you have a small number of lobbyists and a small number of politicians who spend all of their time together deciding what it is that they want to do, such that the voting once every 4 years becomes almost meaningless. The decisions ultimately get made by a small group of people because that small group of people have concentrated interests and a concentrated network. And proof of stake almost inevitably creates that same kind of situation. And Lido, I think, is exactly the example of that. Like, go try and influence anything in Lido or even know what's going on there. It's impossible. And it's only going to get worse over time. The United States has had the same government system for 250 years. It's been progressively getting worse because the system ratchets up, right? People become less and less informed, they become less and less interested as their influence wanes, and the people who are working with each other and change, and have their ability to focus their entire effort on effectively governance become more and more sophisticated, and their network grows narrower and narrower over time. And so this is just an inevitable economic or game theoretic outcome. And so the really interesting thing from my perspective in terms of proof of work is that proof of work is effectively a proof of burn. You constantly have to show that you're burning capital. And when you're constantly having to show that you're burning capital, you're only able to earn the marginal value. And you're like a farmer, right? You're constantly working the land, right? You're burning labor. Whereas proof of stake is a system of rentism, right? It's a system where you don't have to expend additional labor. You just capture the rent from the system. And so it's being like a landlord. And so if I have to choose a world where it is managed more by laborers and farmers, or a world which is going to be managed more by landlords, I'm going to choose the world that is managed by laborers and farmers every time. It's a much more egalitarian, much more open, much more permissionless world. It's a world which doesn't create inherited elites. And unfortunately, I think that is what the proof of stake system, any proof of stake system, including the Ethereum system, is recreating. And so, we started this conversation by saying we've taken everything bad in finance and recreated it in the last 5 years. I think what's worse is that we're taking everything that's bad in governance and recreating it as well. And so I think, my big hope for Bitcoin and for the crypto space generally is not so much for finance, but for us to be able to reorganize the way society is built, to think of a fresh new way of creating productive collaboration between people that is permissionless, that is trustless, and that is equal, provides equal access. I think proof of work does that. I think proof of stake inevitably fails in that. And so as much as I admire the Ethereum community and the Ethereum culture, I think, unfortunately, it has a deep and unavoidable black hole at its center.
Good show. I did just get a question in for you, Yago. If you have time for another, it says, hi, what can we do to make people like Sailor see Sovryn as a real competitor to Lightning?
So I don't think Sovryn is a competitor to Lightning. I think Lightning is very good at what it does, but extremely limited in what it can do. I think Sovryn is not an infrastructure being built for Bitcoin, which Lightning is, right? Sovryn is built on Lightning, so it's integrating with Lightning and it's integrating with Rootstock and now we're working to integrate Taproot to make it really easy for developers to build on Bitcoin. But I don't think it's a competitor to Lightning. But let me take the other part of that question. How do we get Sailor to notice Bitcoin? sailor to notice things like Sovryn. And I think the answer to that is that we build useful shit, and we grow it so that it becomes undeniable. And I think that if you build things which are fundamentally useful, then they will get adoption, and it could take time, but that they're going to be there to stay, and they will become undeniable. And so I think the way that Sovryn's goal is to extend the capabilities of Bitcoin so that we can build a world on the principles of Bitcoin. I think that's an undeniably good idea. And I think it's going to also prove undeniably useful. The ability to access the value of your Bitcoin without having to sell it, I think, is a massive. It's undeniably interesting to a lot of people. The ability to build a new form of institutions, right? Like self-governing, self-regulating financial system, which without the need for an SEC or a CFTC or a Congress. I think that's undeniably valuable because it provides access to a well-functioning financial system to everyone from, Central African Republic to New York to El Salvador. I think these things are fundamentally where we're going. Our current set of institutions, everyone knows that they're rotten. Everyone knows that they're not fit for purpose anymore. We've entered into a digital age with industrial age institutions. Very few people have a view of what comes next. I think Sovryn does. I think Ethereum does as well. I just think Ethereum's just mistaken on the fundamental level. On many of the other levels, I think the Ethereum community has great ideas. And so I think by merely presenting useful products, we'll get adoption from the people who aren't ideological, which is the majority of people who just want to live their lives. And by providing fundamental value, we'll get the people who ultimately lead culture and lead revolutions and change the way humanity thinks. And those are the people who are ideological. And so, I think Sovryn does both, and over time that will be reflected.
All right, very good, gentlemen. Yep, I don't have any more questions now, but been getting really good feedback from all the channels throughout this. Lots of questions coming in throughout the course of the space. Do you have any other clothing thoughts, fellas, or anything you'd like to tell our audience?
I was just saying thank you for being here. I'm having some major phone issues, so I wouldn't be surprised if everybody isn't hearing me. But thank you.
All right. I want to thank Scott for joining us and everyone else who joined as well. It was an interesting conversation, and I think the best conversations typically happen in the bear markets when there's less noise. So I hope that the signal to noise ratio will rise again. Thank you everyone for joining, and stay sovereign.
Thank you. Really tremendously enjoyed both of you. It's at Scott Melker if you want to follow Scott, and at Edan Yago, and at Sovryn BTC. And thank you very much, everyone. Stay sovereign. Thank you.